Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. Roll on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you get it. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Put it back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It is the day. CPI. Hey, let's see where the market is at here real quick. Not that it really matters, because we all know that it's going to be not much of anything overnight. Yep, not much of anything, although they are a little bit lower, so it does look like some fears about CPI being high are coming through. Oh, I guess we do have something to talk about. Towards the end of the day yesterday, market fell apart on a fake CPI report. So it just kind of goes to show you how on edge this market is. This fake CPI report was saying that it would be 10%. Like, whoo, okay. Oil struggling down below $100 again. Natural gas kind of on the way up. Gold and silver continue to be pressured by a strong dollar, as is copper. And Bitcoin, I can just give me just a second here. Bitcoin dipping back below 20,000, but not to new lows. Again, the dollar fairly strong, up around 107.5, where it's been for the last 3 days. So we've got this CPI number to come out here. Let's see here. I'm all in. Okay. Financial juice. The CPI, core CPI, month over month, the expectation is spot 5. That's the number that I'm going to be really interested in, but those headline numbers are also going to matter. And the headline, year over year CPI, they're looking at 8.8. I am not going to take a trade. In fact, I only got 2 minutes here, so I am going to switch my workspace to the, slightly trimmed down one. Less information, but faster. I can see a little bit of, that's interesting that the treasuries are kind of moving up here. That's interesting. And close this other one. Close. So I'm not going to put any trades on this because this is just going to be insanity. But let's watch her here. We could play some sim trades maybe, and pull this one up open, so I can play some sim trades for fun. 30 seconds. Oh, they're pulling for it for sure. Okay, it is 1 spot 3 core. Core is plot 7. Oh my. Oh my. That is not good. Ooh. Well, I would love to put an order in there. If I could buy it anywhere below 3% in the 10-year, like, yeah, giddy up. But look, my micros aren't even updating. Oh, this is interesting. So the headline CPI month over month was higher than expected, 1.3 versus 1.1. But the core was 0.7 versus 0.5. So that was not good. I think that while we're waiting, now it's updating for me. Like I said, anything below 3, yes, let's do it. Heck, even at 3.2, I could probably justify it, but I think that we're going to let it settle a little bit. Let's go read the report. Latest release. So let's just skip down to the bottom here. See, where was it coming from in the core? All items less food and energy. Apparel. Services. Shelter. Transportation services, 2.1. Medical care services, 0.7 versus 0.4 before. So it looks like... interesting. So now let's read their little blurb, all right? Consumer price index for all urban consumers increased 1.3% in June on a seasonally adjusted basis after rising 1% in May, the U.S. Bureau of Labor Statistics reported today. Over the last 12 months, the all items index increased 9.1% before seasonal adjustment. The increase was broad-based, with the indexes for gasoline, shelter, and food being the largest contributors. The energy index rose 7.5% over the month and contributed nearly half of all items increase, with gasoline index rising 11.2% and the other major component indexes also rising. The food index rose 1% in June, as did the food at home index. The index for all items less food and energy rose 0.7% in June, after increasing 0.6% in the preceding 2 months. While almost all major component indexes increased over the month, the largest contributors were the indexes for shelter, used cars and trucks, medical care, motor vehicle insurance, and new vehicles. The indexes for motor vehicle repair, apparel, household furnishings and operations, and recreation also increased in June. Among a few major component indexes to decline in June were lodging away from home and airline fares. That's not good. That kind of signals slow down, right? The all items index increased 9.1% for the 12 months ending June, the largest 12-month increase since the period ending November 1981. The all items less food and energy index rose 5.9% over the last 12 months. The energy index rose 41.6% over the last year, the largest 12th-month increase since the period ending April 1980. The food index increased 10.4% for the 12 months ending June, the largest 12-month increase since the period ending February 1981. And that is your CPI report. Man, even at 0.2, you could do it. Well, but it's not. It is. I'm not getting like solid updates here in the 10-year. So we're kind of in the hole. It looks like there could be a gasp back up. Man, S&P 500 just getting slammed. See, hot CPI slams markets. And today is the 13th. Let's fix that. My, ooh, my. Now this 5-year, look at this. Where is the offer? The offer is all the way at 3.122. What? Okay, we gonna fix this. We can fix this. No? Really? Really? Huh. Well, that's interesting. The 5-year should probably be significantly higher. I see when he is out there with me. Look at the so it's inverted here between the 5 and the 10. Sure, but why should the 2 be so much higher? Oh man. That is some insane inversion now that we're getting between the 2 and the 10. We're now inverted more than 10 basis points. 14 basis points. We're inverted 14 basis points. Man, I'm surprised here that the bids, okay, that's a little bit better. And that's probably only because they're heading down. Look at that. Like we could have gotten in at 3.3 or so. Would have already made 30 bucks here. Probably can start trading it now. Don't know if 3.06 is the price, but you do see the spread coming in here a little bit. Do see a little bit of backwash there. See, I don't think I can put it will let me. Yeah, it will reject me. It's too high. Too high of a bid compared to where we are. I can put this one here, but it's interesting to me, the robot's not trying to beat me out. But there's not many robots with it on in the 5-year. So, which is funny because the 5-year's the place to trade it right now. This sounds like a job for TradeWeb. Wait, what is it? What is even? Oh yeah, it's called Refinitiv. Come on. There we go. Why would it start Messenger? That's funny. Come on. Okay, so that's what I want. So, and what am I getting for the 5-year? 3.21. Holy shnikes. So I could bid it up as high as 3.2. Well, I'm doing it. Okay. Well, so I got one of the other robots to come in. The basis has widened here quite considerably, even in the 10-year. It is now like a 2 basis point basis difference. Okay, the robot. Yep. Come on, boys. Let's move them on up. Yeah. You know that it should be higher. Oh, actually, now we're in a good spot. Now we're in a good spot. The 10-year, maybe a little. Yeah. The S&P 500 is going to be a shit show, right? Oh, you're gonna be like that, huh? I'm down. I'm down. I love it. They're like, okay, fine. We'll fill you. No bids. Oh, well, let me do that. Oh, I should be able to do that. Well, that's not good because I'm gonna need a bid to be able to. Oh, because there's no bid at all. That's bullshit. Fuck. So I would have enough margin to put another order up and kind of hold the bid and force them to compete, but the bid is like we have like a 10 basis point bid ask spread in the 5-year right now, and it counts that against my margin, and so that's why it's not letting me bid. Fine, it should be higher though. 3.13. Well, that's not. We say 4, so 3.14. Probably should have been paying attention to that a little bit more and canceled it, but yeah, Jacob, that is exactly what I did. As I looked at it and there was like some bids, there was some offers I saw on there that I was like, okay, I would hit into that, but I knew that it must not be up to date data. It was like the all of the data that I was getting from the micro 10-year was just halted, you know? Uh, I'm sure that it was kind of more of a CQG thing. But so I didn't trade it. There was a point where I could have gone long at like 3.3, but I didn't necessarily intend to be in a trade here in the 5-year, but I got filled, so now we gotta play it. Not ZF in 5YR. Well, the thing is that 118, we were at 118 a while ago. I think we could see a lot further than 118, right? I mean, I know that this move down was almost a point, but I wouldn't surprise me to see a whole nother point more than that today. Right now, though, looks like they're dealing more with the backwash. Definitely going to be articles floating around about 100 basis point hike. Let's do a poll. Hike, question mark, 75 basis points, 100 basis points. Hike, July. Okay. Getting a little better. Oh, actually, no. It's worse. It's much worse. Oh, what does your screen look like? Well, definitely not the best location for a trade, but we're just going to have to roll with it. Now, oil is making a move here. Oil is was initially down here, and oil is now kind of retracing, and maybe even more than that, and kind of hinting that they're going to retrace that move and maybe push higher. And the treasuries, the 10-year, coming back below that 118 area. I'm a little mad that the bid robot decided to pull his bid when I got filled. Oh wait, there he is a little bit right there. Okay, so maybe it's not a complete disaster. There does appear to be maybe another wave of pressure coming. So think that the oil move is mostly correlated with the dollar. That may be. That's actually a good observation. Bitcoin taking a bit of a plunge here, at least to new intraday lows. I don't think that's where do they need to get to be the new low 18,505. Let's call it 18,000 even. Okay. Their offers pulling. Yeah, a little bit. Back to lows. I don't know if that's a move that's going to push them to new lows in the treasuries yet, but we're going to pull this back up to here. Yeah, there you go. That last downtick there was a little ominous, I think. It was just kind of slumped. It was like, oh, you know what? I'm not even showing my screen. I'm sorry. I switched it over to get icon up and hidden, and then so offers still looks reasonable. $10-year has a pretty wide basis here at the moment, but hello, NASDAQ killer. Bonds, gold, and the young all sold off too. I would have thought, no. So, oh man, right, Luke, it's the same thing. Rates go up, gold sells off every freaking time. It is the most annoying thing. It is the most perplexing thing, but that has become the correlation. That's what gold does, and I don't see how gold is any kind of an inflation hedge at this point. You know, dude, stop. I should stop. Wait, what should I stop doing? Anyways, yeah, but the yen is going to sell, right? So the yen is going to tend to be positively correlated with the treasuries, and yeah, that inflation print ain't good for that ain't good for the Japanese. And it's not gold bashing, man. It's just pointing out the current situation. It's the fact. The fact is that every time that we get something that's like a hot inflation print, gold sells. It doesn't 100% make sense to me. I mean, like, I can kind of understand the dynamics that will make it go down at certain points. But for it to be so consistently like that, and for gold to just perform the exact opposite of what we've always been told it should, is just really, you know, because of rate hikes. Yeah, so just now many people say that gold is being manipulated lower. I mean, I see that almost every day now. And I do kind of look at it and wonder sometimes, like, what's going on here? Yeah, the dollar is strong is the other one that's just really. I don't think that I would say that one's perplexing per se, so much as it is incredibly unexpected. That in a period where we continue to have trouble with hot inflation, that the dollar is so strong. By the way, where are we at on the euro? 1.007, but not quite to parity. By the way, that was new low in the 10-year and everything else by about a tick. And it's kind of given me that I'm going to trend look. Everything's lined up. They're trading decent volume amounts down there. Like, okay, backing off. So the pressure is there, but there is still bit of a liquidity hole right there at the lows. So it could be like that all day. It's going to be like zip, zip. It's just going to keep getting sucked back up, and then hard pushes lower. But you see, it's probably going to take volume for them to push lower, but they probably have the cumulative delta. I mean, so like cumulative delta here so far from the news, negative 26,000 in the 10-year. But this is a day where we could see like negative 60K. Sorry for saying no, it was funny. I don't know. I was just kind of like, what is he talking about? Now, oil and gas going down too, that one is a little interesting, right? But I think that one is like, oh, this is really bad for the economy and this is really going to kill demand. Look at how they fumbled to sell. Well, my market data was not at the when the moment happened, especially in the micros, man. My market data was no good. So, yeah. I'm sure that had a lot to do with why they moved the way they did. And like I said, like I could see treasuries going so much lower. I have to show like let's see here. I get like a 30-minute chart in ZN and go back like 90 days. Right. Like we're not even to July 10th lows. Like there's so much more room for the downside. And I think that everything we're seeing here is just like um like there's no limit to how low they can go here, right? It's just they can only move it so fast. But this is a piece of news that I think could very well lead over the next few days to new lows for the year. Well, they push, right? They push, but there is a real hole, right? It's hard. Yeah, we still got the open. Yeah. So what do you guys think the S&P 500 on the open's gonna do? I feel like it's not the end of the world as long as, well, it's never the end of the world. Like if the report had been like what the leaked report yesterday was, that could have maybe have been the end of the world. But no, it's not the end of the world. It's pretty bad though, right? So there's this whole thing. So the thing that I'm really going to zero in on here was that the month over month core CPI number was expected to be 0.5. It was 0.7. And 0.7 is in line with where it has been the past few months. Here, let's pull that up. Okay, here's core CPI. So does that look like we're past peak inflation? Nope, not even close. So this trade that has kind of been coming through the market past month in the treasuries, that the Federal Reserve will have to back off on interest rate increases because they are creating a slowdown. I don't think that trade looks very good at the moment, right? That one looks like, hey, maybe we are getting a recession. Maybe growth is going to be really bad. Maybe the S&P 500 has a lot further to fall down, but that does not seem to be reflected in the inflation numbers that we're getting at all. Inflation remains high, and it looks like the Federal Reserve is going to have to continue to hike aggressively. Yeah, they're going to do a 75 basis point hike in July for sure. And I think let's come out over here to the CME group and look at where they're sitting now for the FedWatch tool. And let's see past July what they're looking at, because I'm betting you in September it's probably pretty close to, oh, okay, that's interesting. So there's actually still a range of targets, but they usually compare. Usually there was like, they would show you like the previous few days. Okay, yeah. So, yeah, it's increased from 25.7% to 50% that they're going to do a 75 basis point hike. But I think that probably goes higher. I think that there's a much greater than 50% chance that they're going to hike 75 basis points. And I wouldn't be surprised to see, we already saw it in chat. Who was it that was saying, they're definitely going to be talking about 100 basis point hikes now? I think so. I mean, I don't know if the Federal Reserve itself is going to speculate on that per se, but the media is, and I think you're going to go through this whole cycle again where the analysts are trying to outdo themselves on how aggressive the Federal Reserve is going to get and all of these things. Yeah, I mean, we could just have all of that fun stuff that we had in, what was it, May, all over again. It was a bad number. Jim Cramer says last bad number. Well, gosh dang it, Jim, stop jinxing it. Financial Times reports breaking news: deepening fears about the health of the global economy have shoved the euro down to parity against the US dollar for the first time in 20 years. That's not breaking news. It happened yesterday. It's above parity at the moment. Well, whatever. Whatever. Energy and grains have been coming off peaks. Well, but those aren't okay. So let's come back here to If we come back to this CPI release, right? Where is it coming from? Transportation services, sure, but shelter, apparel, and medical care services is really high as well, right? So that energy and greens are coming off peaks. I don't know if that solves the problem. At least not until the end of the summer. I know you wasted a breaking news voice on it, right? But I had read what it was before, right? The whole joke was that they were reporting it as breaking news when it was something that happened days ago. The amount of inversion in the curve, by the way. The 2 years all the way up at 3.245. But you know what? The interesting thing is that that's where the 30-year is. So it seems to me like the 10-year is just 10-year and 5 years are just really, really lagging. You're going long the dollar versus the Japanese yen? Short the yen, I guess, could make sense. But at what point does it break lower? That could be interesting to watch. I do not have a course. I'm really not interested in selling education courses. Maybe a book someday. Writing a book. Gold pulling a rally here. Maybe gold in the end pulls out higher. A lot of talk betting against that, if that is for sure, yeah. Well, we are now towards the higher end of the range. So if we wanted to buy rates here in the 10-year at 3.05 in anticipation of even higher rates, I think we could go that way. How did you learn? Oh, lots of different places. I started with the No BS Day trading course. That's about $70. That's a really great course. I have a lot of videos, but a lot of this is experience coming down and sitting and watching every day. The big thing is that past data is not really very indicative of future data. So you really have to know what the future orders are going to be. Really. Here in this case, CPI was bad, so I would expect future orders to be short treasuries, long rates, right? And that's something that we have that can be predictive. I can make the call here fairly confidently that, in the coming week, the interest rates will move higher, right? I can only do that from sitting and watching the news every day and having just seen this sort of thing play out enough and knowing the context enough and so on and so forth, right? So there is no substitute for experience, right? The greatest teacher is the market. You just need to get market data and you have to watch it every day. But I mean, that's kind of the play, right, Jacob, is that the Bank of Japan will be forced to acquiesce. And with inflation continuing to be high in the United States, that certainly puts pressure on them. we've still got about 15 minutes till the S&P 500 opens. FX macro. If you're holding cash, you're losing 9%. If you're holding equities, it's even worse. If there's one institution you can blame for this, it's the central. Well, I mean, they screwed up for sure. For sure. Well, there was a little bit of a move back higher, back to the kind of the O3 area. They're kind of chilling in the where the point of control in the 10-year is. But like it's very different across the curve. You can see the most volume traded way down here in the 5-year. So you can see how there is like pretty extreme amount of flattening in the market today. Wow. Some stop runs here now. Big bid at 06. I would be a little bit skeptical of that one. A little bit. I'm always skeptical when I see a big order, but that I don't really see a reason for 3K contracts. Yeah, people's. Of course he does. Recommendation on educating myself about these weekly financial events. Well, so the first thing is you got to read the last report. Oh, new connection. The you read the last report and understand what every report means. Like you go to Forex Factory and all of the major economic releases for the United States that are listed on there, you read them all and you see what they mean for the currency that they list on, Forex Factory, and read the actual report, right? And then the next thing that you want to do once you know all that stuff is you want to read the analyst reports. So probably the best place to do that is Zero Hedge. Zero Hedge often posts what the analysts are saying going into the event and so on and so forth. And once you've done that for a few months, you get a pretty good idea of like what the narratives are and the context and everything, so that you can kind of make more educated decisions about what might happen when it happens. So that was a pretty extreme bid up there in the treasuries. There was a spoof that pulled on it. I'm not seeing it turn back into selling and push back down yet. This could be a thing where like they're really, really difficult in the short term, even though probably in the long run over the week, they do push rates considerably higher. I mean, I really think that at this point that the 10-year needs to go to 3.5, right? Well, that was a decent. So that was a retracement of at least the kind of the impulsive move that they had up to that high. It's well, not a little bit. It's a lot bit stronger in the 5-year, by the way. So the 5-year looks determined to drag them back down. that is pretty extreme flattening. But you know what? Like when I look at the curve here, yeah, the 5-year is a little out of whack. Interestingly enough, there's a big bend in the curve at 3 years. And then certainly 1 and 2 year notes. And the 20-year, so all of these are like 3.1, and then you got the 20-year, which is at 3.44, which is probably the only one that is really where it probably should be, in my opinion. Okay, well the 10-year, it looks like the 10-year caught up. They're not back to 118 yet. 118 kind of being the big number in the middle of the range in the 10-year. Oh, did I not show him the picture? Yep. Now, when I read a book, a large focus of my book is going to be all of that stuff. It's going to be, here's what all the reports are, here's what's in them, here's what I've seen with them. That decline in the 5-year really was quite fast, and it doesn't look like they're letting up yet. Bitfinex says looks like Bitcoin was only an inflation hedge for Tether instead of dollars. Well, don't get too excited yet. They're only at 1900. They're only at 19K. I would love to see a break of 18K. That could be some real chaos. Like people think that the Bitcoin market has been decimated. There's nothing. There's so much more money to bleed out of that market if it goes. There's the 5-year kind of pushing it again. Oh no, it's like they pulled through that offer. Still got 10 minutes to the S&P 500 open. You see, yeah, exactly. Like I can see 10K, and once they get to 10K, I could even see 5K. But 10K is kind of a little bit more where my valuation says that it should go to. So, but with the way that things are going, and we still haven't gotten regulation, you know, I don't really see any floor on how low Bitcoin can drop. So despite that drop back down, yields are still in the 5 years are still kind of sitting around 3.11. Probably these should be 3.12. They are. Well, the bid is much more in line with what it should be. So that's good. How to not make money trading? No, it will be the Informed Trader's Guide. That's what my book will be called. Or the Guide to Informed Trading. It's just that lumping a physical asset with Bitcoin is unfair. I don't think it's unfair. I mean, it's just those are both the things that claim to be hedges against inflation, right? Honestly, I mean, over the last 7 months, Bitcoin has taken it the hardest, and gold has been also one of the worst performing assets. But really, it's been a hit to all inflation hedges. It's basically so like there's this idea out there, maybe. I don't think that this is like it's something that I see people openly advocate or state. It's kind of more of like the thinking underneath of it. It's like, well, if the Federal Reserve prints too much money and it creates a bunch of inflation, there's these rich people that say, well, it's okay because I can take advantage of that, right? I can put my money in things that will go up when the markets overall go down. And what you're seeing now is no, it doesn't work that way. They inflated the money supply. It's like a tax, and nobody escaped the tax. Everybody lost money from it, huh? In this situation, I don't think that you can say that there is any asset safe from the inflation, right? Like from what I've seen over the last 7 months, the best performing like prudent strategy, because of course you can go short, but that's like a high risk strategy that you can't necessarily do with like your retirement account, right? Over the last 7 months, the best decision was to go cash and just take your 10%. Just lose your 10%. Seriously. You don't care about what this situation? Well, that kind of sounds to me like you're in love with gold and I mean, like honestly, if gold doesn't perform in this situation, what's the point in having it? Like this is the exact situation we're having it. I guess. Well, I guess. And yeah, Peter Schiff has entered the chat. And unless the United States like collapses and we have to have a new constitution and a civil war and everything, right? Otherwise, I really don't think that that's ever going to happen. Okay, so other than that, what's the point of having gold? At that point, like seriously, and this is coming from somebody that owns some of this stuff as a hedge. That said, hey, you should probably own some silver or gold as a hedge against inflation that appears to be coming down the road. And you want to be long rates. And guess what? Like I did all of those things. I was long rates. I had the gold, and I mean I got paid a little bit for it, but not really. In fact, the things that kind of kept my head underwater in this situation has been my long on oil and swinging rates. You know. So is just I think it's important to point out for people in the future, because in the future that's what people are going to say. I think is they're going to say, well, we can print money. It's not that big of a deal, and yeah, you can get inflation, but there are things you can do to protect your investments from inflation. And then I'm going to be like, nope. When you do that, when the government inflates the monetary supply to pay the bill because they really took out way too much debt, there is no escape. Everybody gets hit. That's what it is. Okay, so we had another little swing there. And they're kind of like hinting like, okay, we're going to go even higher. Like they want to make a higher high, but we'll see. We'll see. That move up was a little impulsive, so that might kind of suck them back down. It only works for trading sour milk with potatoes in agrarian society. You say no way they do a 1 basis point hike? You don't think so? Wait, where are we at with that poll? 57% of you think 100 basis points, 43% of you think 75 basis points. So now that, well, listen, there's 16 of you, there's 14 votes. I'll wait a little bit before I reveal my opinion on that. So there's like a 26 sitting up here in the 5-year. It can't be a serious offer. I mean, there's offers that are like way closer down here. Probably somebody could market buy into this, and I bet you all those robots would pull, and then that might be the best offer. How much fixed interest rate debt have the banks loaned out in the past 10 years? I have been thinking about that lately. I just don't know the number. You can find it. I mean, the amount of outstanding treasury debt is there's a place you can look at that. I forget where. I think you can just look at it on the Treasury website. like here's the thing that I find interesting. So there's this guy on TikTok that has been seeing stuff that's just absolutely driving me crazy, because he'll come in and he'll say something and be like, okay, well, the inflation doesn't go up every time they print. So that means that it's not the money printing that's causing the inflation. It's like, no, that's faulty logic, okay? You can come in and you can look at a specific situation and you can say, what caused that specific situation? What caused inflation in this specific instance, right? And then how do we do that? Well, this is where you got to remember, all models are wrong. Some models are useful. So the San Francisco Fed, they created a model that showed that they were accurately able to account for the inflation through fiscal stimulus. Notice it's the fiscal stimulus that they're saying caused it, right? Okay, so that's pretty good empirical evidence so you can come and look at. It's not like it's a conclusive proof. Of course, a lot of things in economics you can't conclusively prove per se, right? But it's a piece of empirical evidence that you can look at to show like that, yes, we can model it out and our model matches the actual real life behavior, right? Well, there's a bunch of different things involved, right? So here's the S&P 500 on the open. Initial move of buy, not much volume on it. I'm just kind of waiting to see here if they do what they did yesterday, where I say that and then this huge sweep sell comes out of nowhere and it just absolutely crashes. Oh man. The treasuries kind of so they had a little bit of a move up. The 5-year like really pushed all the way back down and the 10-year didn't, but now the 5-year is coming back for the rest of them. So we're still kind of in a point of uncertainty in the treasury. They say it's 30%. Yeah. Well, so if you go to the CME website's tool, they were saying that like the 75 basis point hike in September was like 23% chance, and now it's basically like a 50% chance. Volume profile did not update on my Jigsaw. Is that normal? It's something that I think I've seen before, but that's something that like if you do a restart, it might come back. Sometimes what will happen, Axelrod, is that the Jigsaw requests data from the data provider to build the volume profile. And sometimes that call just doesn't get through, or you don't get a response or whatever. And so, it just doesn't build it. And that's probably what's going on there. Okay, so on the hike thing, I think that it's very unlikely that the Federal Reserve would hike 100 basis points without starting to say stuff. I think that the media is going to start coming out and like shoving for 100 basis points, but it's more likely that the Federal Reserve stays consistent and does the 75 again. The one that I think is interesting is September, right? Like, we're a little bit too close to the July meeting. But if we get to September, okay, well, I think that as things stand right now, pretty good chance that you get the 75 basis point hike in September, right? It could be a 100 basis point hike at that point. Like, if we do get a 100 basis point hike, I think it'll be September. If we get, next month's September's CPI is also as bad as this one, then yeah, why not 100 basis points? You tested other DOMs? I've used them all. I've kind of like at least opened up and used them. I certainly don't have as much experience in Jigsaw. I really think that Jigsaw has the best feature set. Okay, so we're now 3-4 minutes into the S&P 500, and the open has been very wishy-washy and directionless so far. Maybe tilted slightly to the upside. Does make sense. They know 100 basis point hike will make markets screech. Would be pretty ugly, right? We are kind of seeing this, like, treasuries kind of moving up a little bit because they think that this is just so bad for the economy. Oh, actually, take that back. Because it had treasuries, the S&P 500 is moving up, treasuries are moving up. I was a little mixed up there for a moment. I kind of feel like that some of the interest rates here are sandbagging. Like, the 30-year is correct and the 3-year is correct, but the rest of them, the rates that I'm seeing, I think are off considerably, especially the 10-year. The 10-year is not anywhere near what it should be. So right now in the 10-year, I'm seeing an almost 3 basis point basis difference. So for whatever reason, it is not coming through in the 10-year. That maybe it could be because there's just too many people doing 2s and 10s. They're selling 2s and buying 10s. It must be. Yeah, that's the only explanation I can come up for it. But you can see there the 30-year dragged them a bit higher. It's interesting because the selling in the 10-year is still like cumulative delta wise, 10-year is at its lows. So that last move was totally, almost completely, the 30-year. Look at that. That's got to be like some short covering fishiness, right? Well, the yields, the spread in the 5-year is coming down more into a reasonable area. There were some trades at 3.125, I guess. Then, of course, before the news. I'm a little bit skeptical about the Treasury's building too much of a retracement of that move, because if they were to take another leap beyond what they did, that would take the 10-year to 3% again, and there'd probably be plenty of people out there that are like, 3%, hell yeah, I'll take 3%. Like, think about this for a second. Let's come back here. Okay, let me show you this. See me, FedWatch. Okay, so 3% would be 300 basis points target, okay? So the July target, oh man, what's wrong here? Oh, is that because they're saying that target is like, that's the 100? There are people trying to price in a 100 basis point hike in now? Yeah. Okay. So that's a change. Right? Now we go to September. Okay. So September, 275 to 300, 300 to 325. Okay. That's like, 51% chance there's going to be 300, 325. Okay. Think about that. So that's the 10-year at 3%. The 10-year at 3% would be below what the market expectation is for the September 21 meeting. Does this thing have further to go? Yeah, probably. And then November, like, look at this. What's going on right now? Because they're selling it. They're selling it. This is just liquidity. The liquidity is so messed up that they just can't keep pushing further. Like this 350 to 375. That like, think about that. Like, think about how crazy that is. Most people are clueless as usual, but I think that most of us who know what's going on underestimate how bad of a position we are in. Well, I kind of feel like that the underestimating pit was part is already long gone. The time for that comment was 7 months ago, Cyrilex. How much worse could it get? I don't know if I care at this point how much worse it gets. It's just kind of like it's already really bad. Oh, I shouldn't say things like that, because at that point it's like everybody's out of home and we're sitting around a metal can trying to warm up, like they're planning for people in Germany, right? winter this year could be brutal. So here's one of the scenarios I'm kind of gaming out in my head that really concerns me. So this whole time we've been kind of saying, well, there's a possibility that this economic weakness lasts through the summer. And after some of the economic reports a week or two ago and everything, I think that we kind of came to the point where we realized that that was the likely case now, that the economic weakness is going to continue through the summer. Okay. So now we get through the summer. Markets tend to be like really turbulent September, October. Okay. So that might be a time when we might see some sort of an economic crisis or something, right? Okay. So then you get after that, then it's winter. Well, so do we recover in winter? Meanwhile, Germany is talking about how they're setting up warming stations in warming rooms because people won't be able to get heat. Right? Like that, it could be a brutal winter for some people. Talks on the news that what? Where on what news channel? Who would be talking seriously about that? Somebody in China must have said something stupid again, huh? It's always those saber rattlers in China that don't think before they open their mouths. So the S&P 500, so far, an okay move up off of the open, but it's really tiny compared to like what we've been seeing recently, and I'm still kind of sitting here thinking that at some point a big sell is going to come in. Who is buying the S&P right now? I don't know, man. For all we know, is just profit taking on shorts. The Daily Post. Oh, okay. So again, just think about it. Okay, the majority opinion in the September rates right now is that it will be 3.5. Sorry, the for September it's 3 to 3.25. 3 to 3.25, right? And we're basically like at 3. We're basically at 3 right now in the treasuries. So the current on the run treasury yields are lower than what the expectation is 2 months out. So that one of the most important things you say on this channel is that trading interest rates helps you with your portfolio. It does. You learn so much about the market, right? You can make, and like the thing is that a lot of people think that with your main portfolio, you just buy index funds and that's all there is to it, right? Well, yes and no. There are still decisions to be made there. Maybe not in your 401k, but in terms of like, when do you start putting money into an IRA? How do you go about buying a house? Kind of a house do you buy, etc. Like these are all that's going to help you with those decisions. I saved going all cash in February. Wow. Well, that was a lucky call then. I mean, I don't know. Like the thing was, is we kind of knew what was happening in January. I didn't have the guts to like just go short the market, right? I just kind of watched it go down every day in dismay and didn't do anything, even though I knew what was going on and that they're probably going to go lower. Like I'm sitting here right now and I'm thinking, well, Weren't they saying that the S&P 500 could go to like 3,400? Right? Like, it seems like you could have a swing trade go short here and so Treasury's being a little wishy-washy here. So they did rise back up a little bit and then fell back down into the hole 118.040. So what's the hard number you think the 10 should be at the next hike? I think that for the next hike, we're probably reasonably priced, if that makes sense. It's like September where I'm like, I don't think that the Federal Reserve is just going to back off, right? They're gonna probably go to 3.5%, if not 4%. And like the thing is that again, if so the market is basically trying to price in what the terminal rate is right now. And because we're getting close to where some people think the terminal rate is, this is where you're getting this bizarre thing where the yield on the 10-year is basically less than what their expectation is for the yield in 2 months. Right? But if next month's inflation report is still bad and there's still at like spot 6 core CPI, that means that the Federal Reserve is going to have the terminal rate is going to have to be much, much higher. It's going to have to be more like 4% and beyond. Right? So I think that there are some people out there in the market. Maybe they're right. Maybe they're right. Okay, like I see the case, but it seems like a reckless trade to me. It seems like a trade that is just way too far out of whack with what we know right now. You're making a really huge bet that everything's going to turn and that by September the Federal Reserve is going to be easy again. Like what? Like seriously, we get one, maybe 2 CPI reports before then for this supposed turnaround to happen. And right now, there's absolutely no sign that it's cooling off at all. Right? This bet, I think is crazy. I'm like more thinking because I just saw this thing here. Where is he? Where is he? I'm not getting everything on Twitter for some reason. Jim? Oh, that was 17 hours ago. My belief is that the Fed will pivot around mid-September. Who takes the other side? Well, you still want to take it, Jim? Still want to take it? There has been a long vomiting. Yeah. But that's like the other part of this is that it's been a very volatile trade in treasuries, and we've had really wide swings every day. And like one day will go up really big, and one day will go down really big. But I think that this news event is a really key inflection point where the sellers in the treasuries win out in the short term, right? You have to trade current sentiment, not trying to pinpoint the rate in the future. Well, I think that so here again is like, it's an example of where the market is inefficient, right? They're going to see this move down and then they're saying, well, it's not really getting very far beyond 3.05 in the 10-year. So that maybe that's as bad as it gets. Well, I don't see how you sit here and not say that they're gonna have to go to 3.25 at the very least, right? It's just not doing it because of the liquidity and spreads at the moment. So there's a lot of people probably taking that bet right now that are getting bad signals from the market. Look at the 30-year get crushed there. Monetary policy changes can be compared to a turning a freight train. They cannot raise interest rates and then all of a sudden go the opposite way. I agree. And like here's the thing is that everybody seems to think that it's going to be like, okay, inflation's bad, we have raising interest rates pushes us into a recession, and then the recession happens and the Federal Reserve can back off of raising rates and we're right back up to all-time highs again just like that. No, probably not. Why? Because the forces that, like, when you look at the central bank forecasts, they're forecasting that this level period of above average inflation is going to last at least until 2024. So I think that best case scenario, you have for the next 2 years a sideways market. I like how the market gets a delayed shock, all thinking that that it will eventually be under control. Well, it's not that it takes time, it's that the things in the economy, the surrounding inflation, have happened over a long period. So if the Federal Reserve were to go from tightening really hard to loosening really hard, that could only happen from a very, very severe monetary mistake. But I guess the market is kind of, there's a lot of people trying to bet that the Federal Reserve is going to make a really, really massive policy mistake. And it's not like the Federal Reserve doesn't make policy mistakes. It's just, I don't think it's a very wise trade to make a bet that that's what's going to happen. Well, they were pushing down there, but like, look, it's kind of wants to stick around that 118.06 in the 10-year. You make a mistake, admit it. Well, they already have. They already have. But there's kind of also this thing about what we should consider a mistake. Should their policy framework be different? I don't think so. I think that they did what their policy framework is supposed to do, and in this particular instance, it just didn't work. And I'm not really sure what you do to prevent, the bad signal in that situation. You have to pull up a DOM for the twos. Is it power? What's going on over there? Are they pushing through some big bids or something? Like seriously, some the yield curve here. So again, another thing is that markets are not informationally efficient. So I think that we have enough evidence to support the theory that interest rates are going to have to go significantly higher from 3%. Okay. But one of the biggest demands in the market right now appears to be flatteners. And so you're getting this thing where like the tens have a yield way lower than they probably should be. There is some reversion coming into it. It looks like the spread is reverting a little bit. Tons of zero prints from the first half hour getting filled in the twos. Okay. Bids or offers. Are you saying offers that have been sitting there and never got filled are getting filled now? Now, one thing that I think we have to think about now. First of all, there is a Bank of Canada monetary report in like 3 minutes. Oh, I totally forgot about that. 2, there's a 30-year bond auction today. Also, beige book and noon. And you often see changes in behavior after the European market closes. Sometime after 11:30 Eastern time. That, or we might have to accept 6% inflation being the norm. I really kind of wonder how long can people, like this past year, it looks like people didn't really get raises, right? How long can that one go on for? Surely that can only last a year or two before people start throwing fits, right? See, 04.5 will go offer, but it's not holding. Nobody understands the problem, but I don't care as long as I can short. I'm a little surprised that shorts in the S&P 500 since the open haven't paid out yet. A little bit of selling coming in here now. Broke the bottom of that at least. Oh no, not quite. For the 10-year, it's more like 0.2502. This is a little volume node right here. But it looks like they might be selling here just before the Bank of Canada interest rate decision. We got about 30 seconds for that. Normally, this isn't a big deal, but last time around it was. So, we shall see. 100 basis point hike from Bank of Canada. 100 basis point hike from Bank of Canada. So how can the Bank of Canada raise 100 basis points and the US not? This might actually be the most significant Bank of Canada decision to the markets that we've ever seen. That's crazy. That's gonna roil markets. You see the S&P 500 selling off, rates coming back up. Does the market price in a higher than 50% chance of 100 basis point hike now? Hey, listen, I still have the pull up. 47% of you said 100 basis points. You can change your vote. You can change your vote if you think they're going to do a 100 basis point hike. Sweet mama. According to South Park, Canada is not a country. The whole thing where they draw Canadians differently is one of the most hilarious parts of that show, for sure. All the jokes about Canada. Okay, so really good impulse lower off of that Bank of Canada move. They did not make new lows yet, and they are kind of balancing back around some of the prices that they were at before. So being sucked back into a hole. Okay, so Bank of Canada is saying they're front row loading. Blame Canada, yeah. There's that bid at 118 even. I'm curious to see if they trade that. Jeez. The Canadian 2-year is yield has changed 5%. Canadian dollar strengthening. Is this going to bring some weakness into the dollar? I might not. Weakness is maybe not the right word, but it does look like the dollar is falling a bit here. Gold, by the way, did recover. Did recover most of its losses. Most, not all. %, probability of Fed lifting rates by 100 basis points on July 27th now, says News Squawk. So if the market was correctly pricing in 75 basis points yesterday, I don't know, guys. I'm seeing the flow. I am seeing the flow in the 10-year, like it continues to be a sell. I'm not seeing the flow in the 30-year. So what I see as, I think, largely supportive of my larger thesis here, that interest rates are going to have to rise considerably, but that it's a difficult road because of spreads and an illiquid market and everything else. So I just kind of have to sit tight, I guess. Okay, S&P 500 did get hit on that, but they're back to where they were. You really have to wonder with the 30-year, because with the 30-year there being an auction today, like sometimes that kind of creates a bid, but like what if the auction comes out? It's really bad, right? That's a possible scenario. So easy to trade today? I don't know. I mean, obviously there was the initial move on the CPI, but the bonds have actually kind of been a little weird. The bonds are kind of like they don't want to move. Like, this is a day where I would expect the market makers to have a hard time, and I think they're probably doing just fine today. We probably, I don't see how you say that at all. So your Hydro's saying we probably topped inflation now. We are also bottomed market wise now, in my opinion. Okay, so what evidence do you have in support of that thesis? So we just had another CPI print where the core CPI was higher than anticipated and was right up near where some of our worst levels. There is absolutely no sign at all that this number is coming down. They've been saying, people have been saying now for 3 months that we've hit peak inflation, and now it's like 3 CPI reports in a row that say no, it's not peak. I'm cutting out. Oh. Maybe the connection is just not the best at the moment. We've had 3 CPI reports in a row now that say, nah, this peak inflation thing we're not seeing it yet. So how do you justify making the bet now that we're at peak inflation at this moment? Right? Now there is kind of a mispricing going on in the market right now, and who knows which side of that wins. Because it's so clear that commodities are coming down and will start dumping. So we kind of talked about that one a little bit earlier. I don't think that like wheat and all of these other things coming down solves the inflation problem in the short term, because we're seeing it in like medical supplies and stuff now, right? It's not the problem is not with all these other things. And if you do see some price declines because of all of that stuff, it's not going to be for several months down the road, right? Before you'd actually see it in the CPI numbers, I don't think. But here's my case. Here's my case. The market is pricing the market was pricing a 75 basis point hike pretty well yesterday. They're now starting to price in a 100 basis point hike. And the expectations for what interest rates will be in September are basically higher than what our current rates are. So we're at 3.05, let's say. We're at 3.05 in the 10-year Treasury, and they're basically saying that they're going to be 3.25 in September and beyond that. Because the longer this goes, the more that it has to be, they have to hike into 4%, then they have to hike into 5%, right? Now, there's a lot of weird stuff going on with market liquidity and spreads. The flattening is really, really starting to get extreme, right? But some side of this has to give. And right now in the short term, I think that the Federal Reserve is not going to come out and say, I know that inflation is super high, but we're thinking about backing off. That's not going to happen. Here's what's going to happen. Tomorrow, Nomura is going to come out and say, yep, the Federal Reserve is going to do a 100 basis point hike, right? And then Jamie Dimon's going to come out and he's going to say, well, they might have to go into 5% now, right? Like, trying to fade this, I think, like as a swing trade, it's a fun. I don't want to turn this into like I'm trying to convince somebody against, but like we kind of argue these things out, right? That's my case right now. I want to be long rates. I don't want to be taking fills on bids in this. No way. Will be proven wrong, like with oil. Well, now the collapse in oil below $100 is very interesting, isn't it? But like I said, just seeing oil and wheat prices come back down in the short term doesn't necessarily mean that our problem is over. I think that is something that can give you a very, very flawed, it's a very flawed signal, right? So again, you got to be really careful with looking at current prices and making big conclusions off of that. Seeing that oil is coming down and saying, oh, okay, now we're past peak inflation because oil's coming back down. There's lots of reasons why oil is coming down right now, and that doesn't mean that it's not going to be right back up at 110 in a week or two from now. Right? When the fixed income market makes a new decision, the Fed comes out and says they are taking the same. Sure, but do you see what I'm saying here? Where it's very easy to make an incorrect assessment of what the market is doing here and what the market is trying to say, because when you look at the pricings right now, you see a market that really didn't like that CPI report, but it doesn't seem to think that the Federal Reserve will be raising rates much past September. Right? That's what the market is kind of suggesting right now. And what I'm saying is the spreads are screwing up the pricings on a lot of these yields. And I think it's pretty likely that by the end of by the time we get to the meeting, that the treasuries will be at, the 10-year will be at least at 3.25, right? Like there is at least 20 basis points to go here. And see, the market is pricing in, but how do you know that, right? Yeah, I'll dance on your grave, I will. You know I mean. You know I mean. When if I'm right or if I'm wrong. But here's why I think that kind of call is funny, is that a lot of people said that 4 months ago and got crushed, right? And they were seeing kind of similar things back then too, by the way. That number that we just got says you're not anywhere close to peak inflation, man. I would be very, very surprised if September core CPI was below 0.5 from what we just saw there. Yeah, I've read some of Nassim Taleb's stuff. Oh, look, they're trying to push to the higher end of the range here again. I mean, I think there's people making this bet out there, right? But they've got to be out there playing the same game as Hydro. I'm not really seeing it in the 10-year volume though. It kind of looks to me like overall the market is selling, but it can't really make any headway because there's such a liquidity hole here now. And so just a little bit of people speculating going long is able to push them to the higher end of this range. I think you got to be careful about that though in the short term, like on today's time frame, because we've still got stuff to happen today, right? Especially that 30-year bond auction. I'm a little concerned about that 30-year bond auction now. And also what we do at the end of, when we get into like European close times. So 90 minutes from now, after we're done. Sure as hell don't like the way that things have been going for us in the 5-year though. I didn't actually want to be, I didn't have a high conviction on that fill, and I should have been canceling it. It could have gotten much lower. No. I mean, I think he's come in and he's made calls both ways that have been good and bad. I wouldn't put any stock into one person's thing. Like again, really what it would come down to is if we're going to make a play like that, what is the empirical evidence that we have supporting both sides, right? So and this is why I'm so very skeptical of the trade, right? What I heard there was the empirical evidence they have is that commodity prices seem to be coming back down. That the commodity markets have taken a hit lately. Well, I don't think that the current market price and trends of those things is necessarily going to be very predictive of where the rates are going to go. It looks like they're going to pierce the top end of this range, though, man. They're just going to squeeze this. S&P 500 maybe starting to lose a little bit of support here. Well, it looks like you guys are still kind of, well, your expectations are pretty close in line with the markets. 57% of you saying 75 basis points and 43% saying 100 basis points. And look, the 10-year is getting close to 3%. Like, again, I don't see how you support prices below 3%. Man, that sounds crazy to me. So here they are. Here they're touching it. 3%. It wasn't already in something I would I'd be stocking it here. There might be another little bit of a squeeze here. Think about this. What level of growth did we have since COVID? Well, I don't think that. So growth does not necessarily correspond to inflation, right? Like the whole thing is that if you don't have good growth, then you have to raise the rates to bring demand in line with that amount of growth that we've had, right? Would you? No, I don't think. I think that the majority of the inflation. Sorry, if we're looking at the increases in prices overall, like the growth in CPI, it's probably less than 1% of it due to the amount of GDP growth that we've had since the pandemic. Would you buy stocks? No, I think that the S&P 500 is probably fairly priced somewhere below 3,400. No, I don't think so. Well, I'm just looking at what's a fair valuation for the S&P 500 is 3,400, right? Dollars. Come on. They're gonna retrace this whole thing, aren't they? I don't know, guys. I think this is all a little crazy. Well, at this point, I think I'm kind of hosed no matter what I do, so. Okay, so you're saying, let's come back here. Let's do it with this one. And it's going. Oops. Let's see here. How do I change it? Oh, there you go. Bars. No. Candles. Okay. So, like, here's the thing. You're saying, if I understand you correctly, is you're saying, well, 3,400 was about where we were before the pandemic. So for us to go to 3,400, you're saying that there hasn't been any growth in the S&P 500 over these past 2 years? No, it doesn't mean that at all. It means that what we were priced at pre-pandemic was not necessarily an accurate reflection of the true value of all stocks, right? We were in an easy monetary regime with interest rates below 2%, and current prices are not a fair reflection of all available information. So it was probably the case that this market in 2020 was already overvalued to some extent anyways, right? But when I look at like what would be a fair valuation today, I say it's 3,400. Or at least that's like the lower end of where we could go right now. Man, the 30-year like just took a real swipe up there, man. Somebody really is really putting on a big bet that the Federal Reserve is not actually going to be able to raise rates. That's got to be what's going on there. I think that they were able to push really far because of low liquidity, because there wasn't that much volume behind it, but it was a very clear move. So I'm just thinking about it. So like the trade that we're talking about is between now and the next Federal Reserve meeting, and then between then and next September, right? But I think that after the next Federal Reserve meeting, there probably is a situation would be very different. We'd want to reconsider what our current position is, right? And I really don't see how you justify a 10-year rate below 3%. Really don't see it at all. Well, market pretty volatile there, man. Now, were we seeing a move anywhere else other than the treasury market on that? I don't think we actually did. The S&P 500 did turn down a little bit, but not really. This move seems to be isolated primarily to the treasuries. We should consider that move could be a profit taking, and profit taking in this kind of market could take a lot of could move things, right? Well, I just can't help but see it here and not want to do something. So let's try and work a little bit. Yeah, I mean, I have all of these currencies up. One thing that I'm noting is that after the Bank of Canada decision, the Japanese yen went significantly lower, even though the treasuries didn't. So again, I kind of seem to be seeing some support here in the treasuries. I do think that somebody is making a counterintuitive play here. I do think that somebody seems to be saying that the Federal Reserve raising that things will come to a head over the next month, and that the Federal Reserve will have to back off of raising rates. That doesn't mean that it's a correct trade or anything like that. It's just that there does seem to be that force in the market making a move like that, right? But more tactically speaking, I don't think that now is a really good time for that kind of a trade, right? Like maybe they're making that play and it works out for them and they take profits today. Like, or maybe they take profits before 9 o'clock. I don't think that you want to be holding this into the 30-year auction, for instance. I don't think you want to be holding long into the 30-year auction, for instance. Yesterday's auction was really bad, right? That's a risky. If CPI increases, doesn't this mean PPI will increase tomorrow? Not necessarily. Not necessarily. I've never really found a very strong correlation between the two of them. But we'll see. We'll see what it is tomorrow. You see how it's difficult for me to get filled at 17.5 and that there was some iceberging at 18? This is the crude build. So it looks like there was a build. Not seeing too big of a move in the oil markets from it, though. Man, oil markets have just kind of been... it's been a story over there, let's say. Okay, fill at 17. I don't think that the flow in Bitcoin means jack squat anymore. Any large player that's making a play in Bitcoin as a macro play anymore, I don't care what their opinion is. Because I think that the evidence has pretty firmly come out against Bitcoin as any kind of a macro play at this point. Okay, so we kind of see if this big move up has any kind of real pullback. At the moment, it has not really had that. So, hmm. I must also say that the S&P 500 is handling this pretty well so far since the regular session. Took the big hit off of the news in the morning, but it is not really pushed too aggressively lower. And in fact, it kind of looks like that they might break out to the upside here. Okay, cool. I am seeing a little bit of weakness in the dollar again here. And the 10-year is back down to lows of the day and cumulative delta as well, by the way. It's just we're just talking here on the short term, right? But the dollar is kind of pushing towards the bottom here. Can I zoom out a little bit? Yeah, I mean there was a lot of dollar strength coming in off of the news, and right now we're really just kind of at the bottom end of the range since that. So dollar is not topped in your opinion. I don't think that where the dollar is at is going to be an effective indication of what rates are going to do. I'm a little surprised that the dollar is continues to be as strong as it is. Typically when you're getting a lot of inflation, you would expect the dollar to not be very strong, right? The dollar looks like it's strong to me because there are concerns about global growth. Is it just that the problem you get here again is that you could have a recession and still have problems with inflation, right? For instance, one of the risks that we're facing in the market right now and that I think was responsible for some of the decrease in interest rates a few days ago, like the beginning of this week, was the concern that China may have to shut down Shanghai again. Well, but this comes back to the whole thing that the risks of further lockdowns is actually an inflationary force, not a deflationary force. That, yeah, it causes economic weakness, but that it seems to result in stagflation, not in deflation, right? That was a decent probe lower, and then right back to the middle at 18. Volume seems a little bit more balanced now, though. Uh, hmm. Oh, well, I've been doing this. I mean, trading futures 5 years, but doing the markets now, it's been like what, 15 years? It's been a long time. Like one of the things that always goes through my head on this. Oh, dude, hold on. Um, I can remember, for instance, the one that always sticks out to me the most was the day that the Federal Reserve announced quantitative easing. The S&P 500 sold off considerably. The thinking at the time was, well, the economy must be in dire straits. This isn't really good for earnings, yada, 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 yada. And that was like one of the best buying opportunities ever. Like the market on that day just got it like straight up wrong, you know? So that was the day, I think, that I truly realized that on short time frames, and I mean less than 5 years, markets are not informationally efficient at all. All available information is not correctly priced in markets. Sometimes the markets are just, people are just wrong about what the impact of things are going to be. Sometimes there are things preventing information from being correctly priced into it. Market is just not informationally efficient. So when I'm looking for something that says like, okay, what is going to happen here for the next July meeting to rates, right? Because that's really the question, is between now and July, where are rates going to be? Where are rates going to be on the day of the Federal Reserve meeting, before the meeting, right? And what kind of evidence do we have? And if my trade is entirely premised on current market prices generated by exchanges, then I think you have a poor argument. Okay. Now, when I can come in and I can look at the current rates and I can say their expectation compared to their expectation of where the federal funds rate is going to be compared to what the 10-year treasury rate is are not in line with each other. Okay? I can say that, right? That is 100%. I'm 100% certain on that one. Okay. There's a price mismatching between that. You cannot have the Federal Reserve going to be raising interest rates in September up to 3.25 and have the 10-year at below 3. That makes zero sense. Okay. The only way that you can say that is if you think that they're only going to do a 50 basis point hike in September. Well, actually, in order for that to happen, it would have to be, you think that they're going to do a 75 basis point hike in July and they're going to do a 50 basis point hike in September. That's what you have to be saying to be selling the 10-year at 3%. Okay? So that's not in line. Somebody on one side of that is going to lose. Which side is going to lose? So then we can come in and we can look at actual data. Okay? So without looking at market prices, but actually looking at data, what I see, what the hell? That was a little weird. Oh, geez. Yep. Well, I got liquidated there. That sucks. Let's just watch this. What's going on here? This is getting really interesting. Yeah, they retraced the entire sell-off. I'm really shocked. I'm really quite shocked. Anyways, so again, we have to look at things that are like inflation, because there are signs in the economy of, oh my gosh, really? Okay. Watch them like careen all the way back down. I don't know. I think I'm done for today. I decided, that I was just going to try and hold that off on the 5-year. I wish that hadn't have happened, but probably part of what you're seeing here is a short covering rally, though, because the volume in the 10-year continues to be quite depressed. Okay, anyways, so when it comes down to the inflation itself, you have to realize that, yeah, like manufacturing activity isn't very good, for instance, right? Like GDP isn't very good. A lot of these leading indicators that we have don't look very good. But those things don't necessarily mean that inflation is going to come down, right? And the problem is that those numbers have not been very good for several months, right? and yet the inflation numbers continue to persist, right? So this is where I say that in the short term, over the next 2 weeks, I think that interest rates are going to be higher. That's the call that I'm making. Wish I could have played it, but I didn't. I don't have enough to play that game today, apparently. So I don't know. I don't know what I do from here about it. I'm kind of not happy with Ninja Trader because of yesterday. I'm kind of thinking I'm gonna go put somewhere else. I think I've made my mind up. Unless anybody has a different idea. We've done this before. We'll do it again. We'll do a poll. Hey, Ninja, go to man, this is just really interesting flow here. After that big bid that was 29.5. No, I'm not going to Sierra. Other. Sierra is becoming too much of a closed ecosystem. It would be the exact same set of problems that I dislike with Ninja Trader. What's wrong with Ninja? I had an issue with my account and it took them 2 hours to respond to me. Like, I would be better at AMP. I would be doing better with AMP. Dance with the devil, you know. Plus, I'm not so sure that the continuum data is good. So, like here in the CPI, I could have taken a good trade there in the CPI, like in the immediate aftermath in the 10-year, but my data was not updating. Well, I've had AMP. Their service was better than what I just got with Ninja Trader. Look at that. Now they're going to 119. S&P 500 is coming up. So it looks to me like the S&P 500 is seeing this lift off in rates as a really bullish sign. I'm thinking back on this now because again, I was messing around with the geez. What am I going to do? So what happened to me was I was messing around in the 5-year and I took a fill in the 5-year that I didn't really want to have, right? If I had really been playing it more seriously and I would have taken a fill at a better spot and could have gotten something out of it. But I was kind of hanging on and couldn't really get out. And I got liquidated. So I do want to bring the spread in the 5-year, but I can't do it like that. Right? That's not the right way to do it. So I can't be coming in and taking fills like that in a situation where the market could move 100 ticks, right? But I do have to be able to. So I think the thing is that I need to be able to provide liquidity and have to be very, very fast. So maybe the answer is that I really will have to be doing it algorithmically. I think. Yeah, I think so. Hmm. So we're just gonna watch this thing. I'm wondering again. So the thing is, there's a 30-year auction. So happens the 30-year auction. What happens after the um after 9/9/30? I'm a little bit skeptical about any kind of a scenario where like we would move back down to the lows for the day, right? Liquidity hit trades have to be. I mean, there's enough room here in the 5-year that sometimes you can do it, but I'm just not. I wasn't paying enough attention. Was the thing? Yeah, that's not what bothers me. So like if I had come in and I had taken a trade in the 10-year and I had taken a loss on it, it would have been no big deal, right? What bothers me is that what just happened there in the 5-year kind of suggests that I can't do the thing that I really want to do with it, because my mind has been obsessed with there is some opportunity here in the micros and I should be able to make money market making in the 5-year and et cetera, et cetera. And maybe if I'm more focused, but thinking around with it there in the 5 years, a dangerous game. Okay. Like, like where I filled was like the worst place to fill. And I wasn't sitting there like I feel really, really confident about that it's going to continue moving up per se. I was just knew that that price was good based on what the spot yields were doing. Right. Yeah, that's the thing. Being focused is hard. It does really feel like so like here's another thing. Oh, they're coming back. Think that they come back. Hmm. So for those of you, you're all saying other. Well, we only have 7 votes. So what is your other brokers that you think would be better? Look, they're gonna come all the way freaking back. Well, where was we at? Oh, here it is. It was 3.158. Jeez. So News Squawk is trying to sort out because they seem to think that this move is unusual now, and they were just reiterating what happened in the Canadian from the Canadian release and what's been there's a speaker coming up. Why those market just fall low little? Which markets fell? I don't know. Oh, do I still have my thing? So where I was, man, that is not so. Look at back where I was trying to make a market. Okay, why don't you try TT? That's not a bad suggestion, Jacob. I'd need to look at how much. Well, I don't really want to add to my monthly costs. That's the problem there. We're trading micros. I don't want to add to monthly costs. Oh, Bitcoin? Well, Bitcoin fell because the CPI print was very, very negative. So that was kind of bad for all risk assets. Interest rates rose and everything. Now that the interest rates have retraced that move and moved to new intraday highs, Bitcoin should probably recover that. I wouldn't be surprised if they end the day over 2,000. But, the treasuries could continue to move around a lot here and everything. So we just kind of see where they're going to go. I think I would rather go to Rhythmic. So, like, if I went to Edge Clear and I did Rhythmic, I should be able to run NinjaTrader and their Edge Clear platform and Jigsaw. Right? I should be able to run all three at the same time and be fine. Well, no, the TT Pro is $150 a month. There's a more reduced one that's like $30, right? But that's just like I already pay $50 a month for Jigsaw. Is too much, Is, in my opinion, too much. Okay, so the Canadian interest rates have reversed as well. At one point, they were up 5%, and now they're just down a little bit. And I don't know, man. So here's the thing. I've been doing a lot of research on the yield curve. I've been trying to find some better edges to kind of be like, here's points where it's advantageous for you to fade the yield curve or whatever, like when mean reverting behavior might come in. And something that I find in the literature over and over again is that the quality of the data for yields is actually not that good. I always thought that, you have the best data in the fixed income market, but the reality is actually you don't. It's not very good at all. This, by the way, let's just I don't even want to mess with this. We could leave it on, but this sim trade, let's just say that it's $1,000 levers. Yeah, I want to spread them. That's exactly what we're talking about, Jacob. I want to do spread trades with micros. Swing spread trades on micros is what I want to do. But when the spread is 10 ticks, I don't think that that's very good. I don't think that that's a very good it's going to make it difficult for you to do that spread trade. You're going to have to get filled on limit at the very least, right? So you got me distracted. My gosh, you can see it that really what happened there really bothered me, right? I made a bad decision because again, I didn't necessarily. I was trying to put an order out there, but I wasn't really looking to get filled per se, And if I was going to provide liquidity, I should have been canceling it and stuff. And I didn't. I wasn't paying attention. They filled it, and then I didn't do anything with it. It never really kind of was profitable for a little bit, but not for very long. So, not only did I not intend to get in that, but it just didn't play out the way that it should have. It was not a very good sequence of events for me. So, but anyways, when I look through the literature, the data for yields isn't very good. If I come over here and I look at TradeWeb, there is like a maybe half a basis point. Like they're not one tick. They're not like a tenth of a basis point difference in TradeWeb. So when I look at the 10-year, that spread of 1 to 2 ticks is about what I see at the spot cash exchanges. Right? So if I want to go and make a historical chart of like a spread using just pure yields and not the treasuries themselves, because here's the issue is if I want to do historical data on like the knob spread, I would have to have historical data on what the ratios have been over time, right? So it's better for me to just do spot yields, right? But the data that you have for spot yield isn't very good. Enter micro treasuries. So micro treasuries gives us a better pricing of what yields should be. It does. So I think that the micro treasuries, if they become more popular, could be a very positive for the markets and our understanding of markets, right? But the problem is just the spread in the 5-year in particular just sucks. So how do I help bring that in? Well, did a terrible job of it today. I should have been just like not having taken any trades today. I wasn't really, after that initial move, maybe on the pullback, maybe I was thinking taking a trade and I would have taken a small loss. That's what should have happened today. Instead, I took a devastating loss on it. But I was kind of thinking about winding that account down anyways, so that part's not, the loss isn't what bothers me. What bothers me is that I don't think I can actually accomplish the thing that I want to do, which is to provide liquidity in the 5-year and bring in the spread there. It kind of looks like even one robot being there prices me out of the market. Even one robot being there, I think, causes me problems. So maybe I just need to give up on that. What do you think? Should I commit myself to never placing trades in the 5-year when the liquidity is low? So it kind of sounds like that's what the prudent thing would be. Yeah, well, treasuries are basically the most liquid market, but that's really only true in the futures. That's what's so weird about it. It is sad to me, to be honest. I want to bring that spread in. I don't think I can actually do it. Well, do what you like. It is fun. It is messing around with them is fun. So one of the things that bothered me there, man, the new squawk is saying a ton of crap. I do got to get going. So something that also bothers me is that if I had another contract, I could have bid it up and I might have been able to work out an exit there, but because I didn't have multiple contracts, I couldn't do that. So, because basically once the spread is 100 basis points, right? That's like the equivalent of 2 contracts. So, sucks. But that's where it's like, maybe I shouldn't be messing with it. Somebody else will make a robot and that's what will bring it in. Well, we can talk about it tomorrow. In the meantime, I will see you guys then, and stay profitable, friends, or at least don't lose it all. Don't know what I just did. Oh my gosh.